Hi friends, welcome back to Murthy Finance Academy. Today, the second company which we are talking about is EPACK Prefab Technologies from PEB space. If you haven't watched my first video on Interact, please do watch that, which is already live on the channel. Before we proceed further, a quick disclaimer, I'm not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. Please do not consider it as a buy or sell recommendations. So EPACK Prefab is executing a high-stakes pivot from a regional prefab player to an integration constructing technology provider. While the marketing narrative emphasizes green construction, the industrial reality is that EPAC is positioning itself to solve the chronic execution bottlenecks of the Indian infrastructure sector, like labor shortages and impossible timelines. By moving the majority of the construction process to a factory floor, EPAC is effectively de-risking the site variable for its clients. As of 9 months fiscal year 2026, the company's consolidated revenue stood at 10,547 million, reveals a business increasingly reliant on its PEB engine, which contributed nearly 9,478 million. Conversely, the EPS packing segment, which is contributing nearly 1,069 million, appears to be losing its relative importance, a trend that demands closer scrutiny regarding its long-term synergy with the core PEB business. So the company's strategic differentiation could be execution speed. The company has a 1.5 lakhs square feet factory erected in 150 hours, which is an old record, and its drastic reduction in client time to market for high capex projects. So it also operates a turnkey model wherein integrated design, engineering, and manufacturing installation all happens in one place, which captures value across the chain, creating which creates high switching costs for the its clients. And there is a clear bottleneck pivot, positioning prefab as a mandated requirement, not a choice. And its embed tech in government tenders for housing and defense is a strategic importance for this company. And growing at a 4 to 5 times the projected industry average is a growth delta for this company. And rapid consolidation of the organized PE market could act as an impact for this company. And the company's ability to maintain this space depends entirely on its capacity to replicate its northern dominance in the western industrial corridors. So the Indian PEB sector is undergoing a structural flight to quality. According to CRISIL, the organized sector is expected to expand its market share to 60 to 65% by fiscal year 30. So while the industry is projected to grow at a healthy CAGR of 9.5 to 10.5%, EPAC is currently outstripping this growth rate, acting as a high growth proxy for India's industrial capex. So the company is betting on data centers, which is projected to grow 30% CAGR in capacity growth by fiscal year 2027. Speed of construction is the primary barrier here, playing directly into EPAC's hands. And second sector where it can bet out renewables. Major wins from Reliance and Adani validate EPAC scale. In the solar or wind sectors, site offices and storage must be operational before the first megawatt is generated. And third is the semiconductors. The 76,000 crore India semiconductor mission is a multi-year catalyst. EPAC's ability to provide controlled factory manufactured environments is essential for the precision required in this sector. EPAC isn't just a construction company, it's a pick and shovels play for India's high-tech industrialization. In the prefab business, proximity to site is the only moat that matters. Transporting oversized steel components is logistically expensive. A diversified footprint is a requirement for margin production. So the company's regional revenue split for 9 months fiscal year 2026 is from north and central region, it generated 45% of the revenue, south 32%, and west 17%, and east 6%, which is in nascent stage. So the successful land acquisition in Gujarat near Vidalpur is a strategic necessity to tap into the automotive and electronics hub. However, from a spectacle analyst view, the western expansion represents a major execution risk. Entering the competitive western corridors require more than just land. It requires managing a new set of local supply chains while maintaining the 10% plus EBITDA margins achieved in the north. So here revenue for this company is vanity, EBITDA is sanity, cash is king. But for EPAC, the headline numbers are impressive, but the cash conversion tells a more nuanced story. If you see its income statement, the EPAC reported a 31.3% growth in consolidated revenue, and PAT margins expanded from 4.9% to 5.9%, a sign of structural operational leverage. This suggests that as the scale of projects increases, fixed costs are being absorbed more efficiently. And the company is having a net cash of strong at 1,840 million, and its CFO versus PAT divergence is where the CFO was 577 million against a PAT of 623 million. So which is a healthy sign. And the working capital signal, net working capital days has increased from 35 to 38 days. This 3-day creep explains the CFO to PAT divergence. Cash is increasingly being trapped in inventories and receivables as project size balloons. And the company also utilized its IPO proceeds to pay down 700 million of debt, a positive signal for balance sheet hygiene. So EPAC is growing fast and profitably, but the quality of those profits is being tested by longer project timelines. They have plenty of cash and low debt, but we need to see them turn those high margin orders into actual bank balances more quickly. So if you see, the company's utilization rates are leading indicators for future margin compression or expansion. If you see its order book, it is grown by 57.5% year-on-year growth, reaching to 12,155 million, which is an excellent visibility till fiscal year 2027. And its greater Noida utilization is around 81.4%, running at near peak efficiency. And it Giloth utilization is nearly at 79.7%, showing steady performance in the north. And Mumbattu utilization is around 56.5%. Despite holding the world speed record, this facility is underutilized, suggesting a lag in southern demand or a ramp-up delay. Its return ratios are also wherein ROC is around 21.5%. So with northern facilities at 80%, the brownfield expansion in Mumbattu and upcoming Giloth Phase 2 are non-negotiable for EPAC service its 12,155 million order book without losing execution speed. So management is generally aggressively moving to have prefab mandated by system design. This is a high-level lobbying play intended to move the product from a procurement choice to a mandatory specification in government housing and defense tenders. So the company is having a EPS segment lag. Management calls EPS high potential, but the numbers suggest that segment is actually shrinking relative to the prefab engine. This divergence must be addressed. And a rare bright spot is the sandwich panel ramp up, with utilization hitting 34% in Q3, up from 18.5% yearly average. For a technology provider, there is a glaring absence of discussion regarding the AI-driven design for building information modeling integration. This remains a long-term risk to their tech premium. So the management is building ahead of demand, a classic high risk, high reward strategy. Their operational credibility is high. They did exactly what they said they would do with the IPO debt, but their focus on the lagging EPS segment seems more nostalgic than strategic. Currently, the EPAC is priced for perfection. Historically, PEB players command a premium over traditional contractors like L&T because they own the manufacturing mode and avoid the site headaches. With a prefab CAGR of 46.2% and an order book growing at 55.7%, the current valuation is better on the 40% plus growth rate being sustained for the next 2 to 3 years. If the Gujarat expansion hits any roadblocks, the current premium could evaporate. So the stock is an expensive but high quality play on India's industrial boom. Its fair value, if you believe the 40% growth continues, it's very expensive if the working capital creep signals a broader slowdown in execution. So what are the some key red flags in this company here? Number one, raw material volatility. 7,332 million was spent on cost of material consumed in 9 months fiscal year 2026. It still accounts for nearly 70% of total revenue. Since most PEB contracts are fixed price, a 10% spike in steel prices could wipe out half the PAT. And second, customer concentration. Heavy reliance on sunrise sectors means EPAC is a hostage to capex cycles of data centers and renewables. Third, order book fragility. Management explicitly warned that some orders received may be cancelled. This adds a layer of phantom growth to the 12,155 million pending book. Fourth, execution track. The Gujarat and Giloth expansions are massive. Any delays kills ROE as the company sits on non-productive assets. If you see some SWOT kind of a thing, key strengths for this company are strong net cash with 1840 million, record breaking speed of 150-hour erection are its key strengths. And coming to weaknesses, lagging utilization in Mumbattu with 56.5% utilization rate and creeping working capital days be watched out. And coming to opportunities, India semiconductor mission could be acting as a catalyst, and mandating prefab in government tenders acts as a key opportunities for this company. And coming to threats, steel price volatility, because nearly 70% of the total revenue goes into procuring steel. So this could be a threat. If there is any volatility in the steel price, this can directly affect their margins. And shrinking growth in the EPS packaging segment could be a serious threat for this company. So what are the key monitorables to be watched by investors? Are its order flow run rate needs to remain above 3,000 million per quarter to support the valuation. And second is Mumbai to ramp up, watching if utilization moves from 56.5 towards the 70% mark or not. And Gujarat timeline, progress on phase 1 expansion for fiscal year 2027 commencement. And its CFO to PAT conversion, watching if cash flow catches up to profit or if the WC cycle continues to expand or not. Fifth is steel price exposure. Monitoring the cost of materials as a percentage of revenue is most important in this type of company players. And sixth, EPS segment fate. Will management divest or double down on this lagging arm or not? We need to see. And in recent times, the company also won major orders from Reliance, CG Power, and Avada validate EPAC's ability to clear the high pre-qualification hurdles of India's top-tier corporates. And this 140-hour erection is a golden book of world records. So, wherein this allows the company to bid for projects where time is the most expensive line item on the client's balance sheet. If you like this video, please do like, share, and subscribe to Murthy Finance Academy. If you have any questions, please drop them in your comments box. I will try to answer them. Also, I am posting regularly some community posts on various companies which, due to time constraints, which I might not cover through a video format. I am posting it over there. Please do read them as well, and please share your opinions on those things also. If I need to improve on something, please let me know. I'll try to improve upon it. If you like this video, please do like, share, and subscribe. If you haven't done it, please do it soon and support me. Thank you.